Are you tired of writing 5 or 6 figure checks to the IRS every quarter? What if I told you there's a perfectly legal way to reduce your tax bill by the score of tens of thousands to hundreds of thousands of dollars without working more hours? In this video, I'll show you exactly how I and many of my investors legally reduce our taxes using a strategy that the ultra wealthy have used for decades. It's called bonus depreciation. And dentists, you need to know about it. Hi guys, I'm Dr. Jonny, aka Jonathan Withanachi. I'm an endodontist turned fund manager, and I'm the founder of Walk of Wealth. If you're a high income professional, taxes are they are your biggest expense. They are the crusher of compounding wealth. But here's the truth. You're likely overpaying. Not because you're doing anything wrong or your accountant's doing anything wrong, but it's because no one ever taught you how to do it right. You're working 4 to 5 days a week, producing $1 million plus annually, and then watching 30, 40, or even 50% of that income disappear to the black hole called taxes. And you've probably asked your CPA, hey, how do I pay less? I'm paying so much money to the IRS. And they say the same thing every time. Just go max out your 401k plan. Fund a backdoor Roth or fund a SEP IRA. And that's fine and dandy. And you should do some of these things. But those are just mere scraps. The tip of the iceberg of what's compared to what's really available. If you're a W-2 or 1099 earner and you're not leveraging bonus depreciation, well, point blank, you're leaving money on the table. A lot of it. Let's break it down simply. When you invest in real estate, the IRS lets you deduct the wear and tear of the property over time. And that is called depreciation. But with bonus depreciation, you can accelerate those deductions into the first year of investment. And here's where it gets fun. When you invest passively into a real estate syndication, say, for example, a multifamily deal, or say some self-storage portfolios, the operator typically does what's called a cost segregation study. Now that, we're not going to go into the details of that in this video, but that study will allow you to write off a huge portion of your investment on paper. It's completely a paper loss, even if the property is profitable and producing cash flow. It's not a loophole, it's the law. Now let's say that you have $100,000 to invest. And let's say that you invest those $100,000 into one of our syndication deals. Now, at the end of that calendar year, you might receive a K-1, which is a document for the IRS that describes the activity of your investment. And that K-1 may show a passive loss of $60,000 to $80,000 in year one. You invested $100,000 and then you get $60,000 to $80,000 of losses in year one. Now here's the kicker. You may still receive monthly cash flows from the investment, but on paper, for accounting and IRS purposes, you lost money. And those losses can be used to offset income from the investment. Sometimes W-2, 1099, or even capital gains taxes can be offset from depreciation. Now, it depends on your situation, what type of asset class you're investing in, and whether you qualify for a real estate professional status. Now, this is what Donald Trump does. This is what Jeff Bezos does, and Grant Cardone too. And now, dentists can do it too. They don't avoid taxes because they cheat. They avoid taxes because they invest in things that the IRS incentivizes. And real estate, especially large commercial real estate, is one of the most heavily incentivized assets on earth. This sounds too good to be true, Dr. Jonny. Well, Doc, it's not. It's just complex. But I've walked dozens of dentists through it step by step. But Dr. Jonny, isn't this just for rich people? No. If you can invest $50,000 or more, you can access the same tax strategies as billionaires. But Dr. Jonny, why doesn't my CPA tell me about this? If this was so true and you can save all this money in taxes, why does my CPA not tell me about this? Well, Doc, most CPAs are reactive. They're not strategic. They're there to file returns. They don't design tax plans. So that's a different service. And most CPAs are not trained in the alternate space, commercial real estate, oil and gas, etc. They're only trained in the area of conventional investing, 401k plans, stocks and bonds. Now, this isn't just about saving on taxes, ladies and gentlemen. This is more importantly, this is about buying back time. Because when you keep more of what you earn, well, your net income goes up. And if your net income goes up, you don't have to work as many days or as many years. I know dentists who cut a full day off their schedule just by using this strategy well. And I'm one of them. All right, if you want to stop donating 40% of your income to the IRS, and start keeping more of what you hard earned, this is just the beginning. Make sure you watch the next video in this 8-part video series. And if you want access to the kind of deals we talk about, along with hands-on coaching to help you build your strategy and your wealth, click the link below to check out our Walk of Wealth Mastermind group. It's not for everyone. There's an application process. And once you're in, I guarantee value. Let's keep more. Let's earn more. And most importantly, let's live more. I'm Dr. Jonny. I'll see you next video.